Good afternoon, everybody. Welcome back to my channel. It is me, the Wing Man. I'm here to bring you and deliver that delicious sauce. And hey, if you haven't known by now, if you don't know by now, my channel is all about financial planning, investing, and basically putting yourself in the right direction to actually make money, not only in the stock market but be able to retire. And hopefully, you listen to everything that we talk about today and hopefully maybe you'll be able to retire early. So this video, it's not going to be a long video. I'm going to be talking about just wealth management strategies and just some statistics in regards to individuals trying to uh, do retirement planning for your retirement, and just basically, hey, listen, we just came out of COVID. A lot of individuals are not saving enough, or probably had a financial pitfall due to COVID, and do not fear. Do not be depressed. Be just use this video and some nuggets and some strategies that I'm going to give you guys to look into. And then hey, brush yourself off and let's try again. Shout out to Aaliyah. So today, we're not going to go through all of these statistics, but we're just going to go through some key takeaways of just financial planning. So basically, you came here, you watched the video because you want to sit down, manage your finances to ultimately plan for retirement, whether you are at age 30, 35, 40, 40 plus years old, or even you may be in your 20s, and you see that hey, that retirement is down the line, and honestly, everything around us is changing with AI. People are losing their jobs, and uh, yeah, a lot of people are not saving enough for their nest egg to retire. So, what are the key takeaways? So, here's one of them. 3 in 5 Americans say that not having enough money in retirement is a top financial concern. However, 80% of current retirees say that they live comfortably in retirement. So, right now, 3 out of 5 say that not having enough money in retirement is a top financial concern. But for the individuals that are in retirement, 80% say they currently live comfortably. And so what you find is that when you eventually do retire, there's different levers and avenues for you to rely upon for your retirement, like Social Security. If you have a small business, if you work part time, probably at like Starbucks or Walmart to get some health insurance. So there are different avenues when you are in retirement to make money, and then also let's say that you have a small business, you have money coming in from your small business, etc. So it's just as Americans or as just individuals who are trying to plan for retirement and put a plan in place. You got to get there. So how do you get there? So 27% of Americans say that they have decreased or stopped retirement contributions in the wake of COVID-19. I said that a lot of individuals were hit hard due to COVID-19 and had to dip into their retirement funds, whether it's in their 401ks or their personal savings and their taxable accounts to fund whatever they needed to. 38% of Gen X and 35% of millennials have no idea of how much they need to save for retirement. So a lot of my videos that I'm about to roll out, this is the first video of about maybe 4 or 5, called the Saving Money for Retirement series or retirement planning series. And this series that I'm going to roll out is to help you and your spouse, or you and your family, whether you are 20 to 55 years old, to take some nuggets and strategies to, if you haven't started investing for retirement, for you to begin to start right now. And if you have, begin to start some key takeaways, the key things for you guys to take upon to sharpen to get more returns. Because as you see right now, the stock market is green one day, red one day, but at the same time, in the long run, how is your returns, whether it's in the stock market or crypto? Here's the last one I'm going to go over it. 57% of current U.S. retirees say that they rely solely on Social Security as a significant income source, but only 38% of non-retirees say they expect it to be substantial income source for their retirement. So again, over half of U.S. retirees rely solely on Social Security, and typically, if you are after the year of 1957 ish or 55, whatever that date, uh, our retire date is at the age of 67. So if you're able to work and work and work and save and build up to at least at the age 67 for retirement age, a lot of people are making, I want to say, between like 1,500 to 1,700 a month on Social Security, and they are living on that, and it's great. Now there are rumors that Social Security may run out, blah blah blah. We'll talk about that. But most importantly, what we're here is basically we're here to talk about what are some of the worst mistakes that you can make when you're trying to plan for your retirement. And so some of the things I'm going to talk about, and some of the things I'm just going to skip over because it's probably boring and don't really we don't really need to talk about. Here's some key takeaways. If you think your retirement savings are on track, make changes while you're still working and create a financial plan. Save as much money as possible by contributing to your work 401k up to the match, just only up to the match, and then anything after the match you put into your own, either your own taxable account or you create your own IRA, and then you begin saving that way as well. Always keep in mind taxes and penalties when you're financial planning for the future. Sitting down to see, hey, am I going to be when I retire? Am I going to be making a lot of money, or am I going to be making probably bare minimum money? Because then when you take that into consideration, then you take into consideration taxes and what tax threshold and bracket you'll be in, and then always when you're planning, don't forget about healthcare costs. And so we're going to skip like don't quit your job, but one big mistake that when people don't take account is that a lot of time. Time is the most important factor when it comes to investing into anything, whether it's starting a YouTube channel, starting a business, uh, investing, whether it's investing to ETFs, index funds, or investing into uh, just crypto. The sooner you start, the sooner you begin to make mistakes and learn and grow, and the quicker you can go and you learn from your mistakes, and you can begin to, with time and with wisdom and knowledge, let your money what compound. But if you don't start, if the secret to compound is that you have to have something to start with, and then with time and you add to it, it gets bigger. But when you, as a snowball, when you start with something small or nothing at all, it takes time to pack and build that snow. Rather, if you have a solid foundation. So a lot of times with individuals not save anything or not saving out, you're putting yourself in a tough situation. But it's not grim or it's not futile, but it's just a tough situation. So it all starts with your mind to figure out, I got to start now. And how you start is you start with your 401k. If your job matches up to 3% or 4% or 5% dollar for dollar or 50-50 cent, then you invest up to what they're matching. And then the next thing you do is that you open up your own IRA and you begin to choose which brokerage accounts you need to use, whether it's E-Trade, Fidelity, M1 Finance, or even Morgan Stanley, Goldman Sachs, whatever brokerage that you need to open up to begin to invest into stocks and invest into gold and silver and commodities and crypto, then that's what you need to do outside of your 401k. And a lot of times as well, open up a Roth IRA, and then while you're still young and you put money into your Roth IRA and you let it grow, all your money that you put into your Roth IRA grows tax free. And so because you're paying tax on your money then that year, so the money that you put into the Roth IRA also grows tax free. But also keep in mind that these tax vehicles also have limits of money that you can put into these tax vehicles. Another pitfall that people that's trying to plan for financial for retirement is that they don't have any type of financial plan. Uh, and the number four goes hand in hand with the not saving now, meaning that you're not maxing out your company match. So if your company is maxing, like, oh, we it's gonna max whatever you put in dollar for dollar up to 4%, 5%. You should cater that for your gross up to the match, and you don't have to put in anything extra. Just if your company plans on want to match your money dollar for dollar up to 4%, 4.5%, then partake in that to that free money because your company is giving that to you. And then uh, one thing is investing unwisely. So a lot of times in the past, a lot of individuals will invest unwisely by investing into mutual funds with high expense ratios, and the expense ratio is basically what you're paying the fund manager to invest your particular fund, your money into these different funds. And so if it's 1%, 1.5%, 0.8%, it's quite high. So rather it's in a good market when the market is a bull, or the market is down when it's a bear. You're paying this fund manager, and so it cuts into your rate of return. So let's say you uh, incur good rate of return over the last 5 years, but each year you're paying 0.8, you're paying 1%, 1.5%. That's eating it into your returns, and that's for a good year. If you are invested and it's like a bad year, like right now, where it's been a bad year in 2022, and looks like it probably be a bad year in 2023. When the market is down, you're still paying that expense ratio because it's the fees that you pay the financial planner, the financial advisor to manage your particular mutual fund. So what people tend to do is just invest into uh, index funds or ETFs with just low index costs like VOO or FX8IX, uh, VTI, just these different QQQ, even QQQ, which has a 2.20 expense ratio compared to a 1%. It's quite low. And then a lot of times, what people don't take into consideration is poor tax planning, but that's only when as a highly compensated, highly net worth individual. Once you master uh, these small tricks of financial planning, you're managing your debt, buying a house or buying houses and increasing your net worth, invest into stocks and ETFs, whether it's Apple, Microsoft, Tesla, or index funds, QQQQ, or FXAIX, or Schwab SCHG, where you invest in all these different funds, assets to grow your wealth. Then once you get to that point, then you talk to a tax accountant or a tax advisor or a retirement planning tax accountant that help you to manage the different pools or the different buckets that you can use to pull your money from. Oh, because then at that point you have a net worth of 500,000, $750,000 worth of assets. Then you talk to them to figure out when you want to retire at 50, 55, 60. Then do you pull it from your Roth IRA? Do you pull it from your 401k? Which when you pull that money out, it comes out as ordinary income. Do you want to do that? When you get up the age of 65 or 70, I think they raised to like 70 or 75. When you have to do RMDs, required something distributions, then it forces you to pay taxes at ordinary income tax bracket. Then it's best when you have a decent enough network of 500,000, 750,000 when you're ready to retire to hire a tax professional to help you with tax planning. But a lot of times we're so focused on planning and getting to and accumulating the wealth. But then once you have the wealth, how do you plan on paying a limited or less tax to Uncle Sam? That's a huge mistake that people tend to do when they're just so hyper focused on the accumulation phase. But then now it's time to preserve your wealth stage, and people don't pay attention to that. And then yeah. So paying attention to your debt, not planning for healthcare uh, costs, and then lastly, Social Security. A lot of times, uh, if you take Social Security too early, instead of 67, you take it at 62, then you uh, occur a cost of where instead of you're making a max of $1,500 to $1,700 of Social Security income a month, then the penalty of taking it early is that you probably be getting maybe 900 to about 1,000, and from there you've already you missed out on $500 per month that you could have been potentially making if you would have waited a couple of years. But at the same time, it's all about how you look at it, because if you have dividend income, if you have uh, a small business and all that. And then also, if people don't also tell you that if you also don't have, if you're not paying so much in terms of expenses and you can live on 30,000, 25,000, then it really doesn't matter compared to some individuals who they need to live off 40, 45, 50,000. So lastly, lastly, I have a retirement planning calculator. And so right here, you can go on like the Motley Fool, or you can go on NerdWallet, and you can play with these retirement planning calculators. And with the right here, for me, for the typical person, they say that the typical person wants to retire at like the age of like 65, 67. For me, I have that, I want to retire at 55. Honestly, if everything goes well, I want to plan to retire by 50, but I put 55. And then right here, um, for me, I I typically save about $1,500 a month in like stocks and crypto, but we're just gonna put 1,000. And so you can manipulate these numbers and play with it. So like I save $1,000, I put into my um I put into my stocks and into my crypto. My monthly retirement spending will be about 3,000 per month. Uh, which is not bad. And then I didn't even go into like putting like once my I foresee that me making videos on my YouTube channel should pick up, then years down the line and a dividend income. And so I want to retire at 55, life expectancy, and then my investment rate of return, uh, it, it will be a lot higher than this because I invest into single stocks and I'm 100% into stocks. But it all depends on your investment strategy. And then for me here on, you can figure out how much you need in retirement. And so a lot of times people don't, when they're financial planning for retirement, they don't know their number. They don't know the number that they need to have to retire. So for me, I already know that I'm going to need to save up roughly 1.5 million for me to retire, and for me to be able to hit that number, I need to be in 100% stocks. I need to be investing to uh, having VUA VTI as my core ETF, and then have my individual stocks of Tesla, Microsoft, Apple, and what else? As my core positions, and then let invest into that portfolio, let that grow, and that's why I have another portfolio of my dividend stocks, and then in my dividend stocks I have roughly about 35, 36, where within 15, 20 years that portfolio is going to grow. It should be about around 500 to 750,000, depends on the growth of that, and then that's going to be producing dividend income, and then from my business of my YouTube channel and all that. And so when you sit down in your planning for your financial planning, it's in accumulation phase when you're in your 20s, your 30s, and your 40s. You need to sit down and understand what are the statistics that's against you, just so you can observe how much the normal American is saving, and then after that, then you come up with a plan, you budget, come up with your plan, you buy assets, whether it's stocks, ETFs, index funds, or if you go down the route of want to buy a house, buy a house personal just for yourself, and then begin to buy houses or condos you want to rent out, so you get the rental property income, and so you'll be able to leverage the renting, and getting that money. And then also, if you want to get into just commercial real estate, you can do that as well. And there's more than one way to skin a cat and to make money into the stock market, make money into the market. It's all about how you want to do it. I'm just here to orchestrate so you can just think about it and for you to figure out what are the mistakes that people tend to make, avoid it, and how to leverage your money to make money in the future. It's all about thinking about for your future self. So hopefully this video helped in terms of the certain mistakes that retirees or individuals make when they are trying to sit down and plan for retirement. Hopefully this helped. And in my next video, I'm going to go into more detail of more funds and ETFs for you to sit down to think about where you can put your money to save up for retirement. So hopefully you guys enjoy this video, and I'm out. It's the Wingman. I got the sauce, but most importantly, with my lovely, delicious chocolate skin, I got this cocoa butter. And you go. Hope you guys have a great day and stay delicious. All right, guys. Peace.